This training is about the 4 numbers that decide whether your insurance practice is a real business or an expensive hobby: cost per lead, close rate, cost per sale, and revenue per sale. By the end, you'll know how to calculate all 4, what good looks like in each insurance vertical, and how to decide whether to keep buying leads from a vendor or fire them. Most agents track gross income. They look at deposits, they pay bills, and as long as something's left over, they keep doing the same thing next month. That's not a business. That's a job with no boss watching. The producers who scale know exactly what they spend to get a client, and exactly what each client is worth. The ones who plateau don't. That's the math that separates them. Here's why this matters more than agents realize. Insurance is a unit economics business. You buy attention, you convert a percentage of it into clients, and each client pays you a known amount. If your cost to acquire a client is lower than the revenue that client generates over time, you scale. If it's higher, you're losing money on every sale and trying to make it up on volume. That's the trap. 2 fears keep agents from running these numbers. The first is the quiet suspicion that you're losing money on leads and you don't actually know it. You spend $1,000 a month with a vendor. You write some apps, you assume it's working, and you never sit down and verify. That suspicion is usually right. The second fear is what the numbers will tell you. Some agents avoid the math because they're afraid the answer is going to require killing a lead source they like, or admitting their close rate is half of what they thought. The truth is freeing. The agent who knows their numbers makes calm decisions. The agent who doesn't makes scared ones. Both fears dissolve the same way. Run the math once. After that, the next decision about where to spend $1 gets easier every single time. 4 formulas. Memorize these. Cost per lead. Total spend on a source divided by leads received from that source. If you spent $1,000 and got 50 leads, your cost per lead is $20. Close rate. Sales divided by leads. If you got 50 leads and closed 5, your close rate is 10%. Cost per sale. Total spend divided by sales closed. Same $1,000, 5 sales, $200 per sale. You can also get there by dividing cost per lead by close rate. $20 divided by 10% equals $200. Same answer. 2 ways to verify. Revenue per sale. Total commission earned per closed deal, ideally measured at first year and at lifetime. First year commission is what hits this year. Lifetime commission factors in renewals, which is the real number to manage to. The single decision the math forces you into is comparing cost per sale to first year revenue per sale. If cost per sale is more than first year revenue, you're underwater on year 1 and betting on renewals to bail you out. That can still work in Medicare and in life, but only if your retention is real. If your retention is shaky, you're losing money you'll never make back. Now, realistic benchmarks for 2026. These are typical ranges, not promises. Use them as a sanity check. Medicare. Shared web leads run $10 to $25. Exclusive web leads run $25 to $60. Live transfers run $30 to $100. Cost per enrollment for an organized producer typically lands between $200 and $500. First-year revenue at the CMS Fair Market Value maximum runs around $694 nationally for 2026, with several states higher. Most Medicare lead sources are profitable in year 1, with healthy renewals on top. Life insurance. Shared web leads run $20 to $45. Exclusive web leads run $75 to $150. Live transfers run $80 to $200 or more. Industry analysis shows total cost per acquired life client commonly lands between $1,500 and $3,000 when you factor in close rate and follow-up time. The reason that number works is target premium revenue. A single life sale can pay several thousand in year 1 commission, so even a high cost per sale can pencil if your average revenue per sale is high enough. ACA. Shared real-time leads run $5 to $60. Warm transfers run $25 to $120. Full enrollment leads typically run $25 to $40, with much higher conversion. Cost per enrollment for a competent agent typically lands between $80 and $300. Final expense. Direct mail and telesales leads commonly run $50 to $80 each. Now, the part most agents skip. How to track these numbers in real life. The math doesn't work if the data is messy, and most agents have no system for capturing it. Here's the simple version. Build a one-page tracker. Spreadsheet, notebook, or your CRM, doesn't matter. 5 columns: lead source, date received, spend on that batch, outcome, marked, sold, working, or dead, and first year commission if sold. Every lead that hits your inbox gets a row. Every lead. Once a month, you total each lead source. Spend on that source. Number of leads, number of sales. First year commission collected. From those 4 totals, you calculate cost per lead, close rate, cost per sale, and revenue per sale. That's your scoreboard. 5 minutes a month, run on the first of the month, and you'll know more about your business than 90% of your peers. The mistake to avoid is judging a source on its first batch. New lead sources almost always feel disappointing for the first 2 weeks because you're learning the source, learning the prospect type, and tightening your scripts. Give a vendor at least 1 full month of consistent volume before you decide. 2 months is better. The number that matters is cost per sale on the second batch, not the first. Once you have real numbers, every lead source falls into one of 3 buckets: kill, scale, or optimize. Kill. Cost per sale is higher than your first year revenue per sale, and you have no reason to believe renewals will rescue it. The source is unprofitable on year 1, and the math doesn't work. Stop spending. Use that money somewhere else. The hardest source to kill is the one you're emotionally attached to because it used to work. The numbers don't care about history. Look at the last 60 days, not the last 60 months. Scale. Cost per sale is comfortably below first-year revenue per sale, and the source has volume available. Buy more. Most agents underspend on sources that work because they're nervous about going bigger. If a source is profitable, the right move is to buy more of it until it stops being profitable. Then scale back to the level that worked. Watch your service capacity carefully when you scale. The fastest way to ruin a profitable source is to buy more leads than you can actually call back the same day. Optimize. Cost per sale is close to first-year revenue per sale. Source isn't dead, but it's not minting money either. 2 levers to pull. Either cut cost per lead by negotiating the vendor down or switching lead types, or raise close rate by tightening your follow-up cadence and your first call script. Move one variable, watch the numbers for 30 days, then move the next. Don't change 3 things at once, or you won't know what worked. Here's a real example with numbers. Producer named Jen runs 3 lead sources for Medicare. Source A is exclusive web leads at $50. Source B is shared web at $15. Source C is live transfers at $75. Last month, she spent $1,500 on each source. Source A delivered 30 leads, she closed 5. Total revenue from those 5 at the CMS maximum was about $3,400. Source B delivered 100 leads, she closed 3, revenue around $2,000. Source C delivered 20 transfers, she closed 6, revenue around $4,200. Cost per sale. Source A, $300. Source B, $500. Source C, $250. Margin on year 1. Source A makes about $680 per sale. Source B makes about $160. Source C makes about $440. Decision. Scale source C. Hold source A and try to negotiate the price down or improve close rate. Kill source B. Source B isn't unprofitable on paper, but the margin is so thin that 1 bad month wipes the year. Jen redirects the $1,500 from source B into source C. Next month, her margins jump. The point isn't the specific numbers. The point is that without the math, all 3 sources looked like they were working because all 3 produced sales. With the math, source B was clearly the loser, source C was clearly the winner, and source A was somewhere in between. That clarity changes every spending decision Jen makes from now on. Here's your action step. Today, build the one-page tracker. 5 columns: lead source, date received, spend, outcome, first year commission. Open a new spreadsheet, label the columns, and save it where you'll see it every morning. Tomorrow, log every lead that comes in for the next 30 days. Every single one. At the end of those 30 days, run the 4 formulas on each lead source you use. You'll see exactly where your money is going, exactly where your sales are coming from, and exactly which source to kill, scale, or optimize. That decision alone, made one time, is the difference between a producer and a salesperson for the rest of your career.